Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your June 2020 market update. Well, the markets had a very nice quarter with the large cap S&P 500 index clocking in its best quarterly gain since 1998, returning 20.5%. And the yellow line in this chart illustrates the swift market recovery, a combination of stimulus, positive trends in the virus for much of the quarter, hopes for a vaccine, and economic data that was less bad than expected drove stocks higher in April and May. But in June, which is the purple shaded area here, the market was much choppier as a few of the tailwinds I mentioned went away. COVID-19 started to break out in new areas of the country, and states rolled back some reopening plans. We also had a rise in political tension and more uncertainty surrounding the presidential election, given significant changes in the polls. So where does this leave us year to date? Well, the nice rebound in the second quarter allowed many asset classes to recover a lot of the losses suffered in the first quarter, but most asset classes are still negative. On the equity side, large cap domestic stocks, which is shown by the yellow bar here, led once again, and they are down only 3.08% for the first half of 2020. Small cap stocks declined 12.98%. International developed stocks, which is the gray bar there, declined 11.34%, and emerging markets are down a little less than their developed market counterparts, down 9.78%. And commodities continue to struggle this year, down 19.4%. On the fixed income side, we still have interest rates near historic lows, and so domestic investment grade bonds is measured by the Barclays Aggregate Bond Index, the light blue bar there. That index is up 6.14%, again providing a nice diversification benefit to investors. High yield bonds and emerging market bonds, which are both riskier areas of the fixed income market, are still down year to date. So overall, the market had quite the recovery in the second quarter and allowed investors to claw back some of the losses that were realized in the first half of the year. So as we begin the second half of 2020, we need to think about what it will take for this rally to continue. And Federal Reserve Chairman Jerome Powell and Treasury Secretary Steven Mnuchin testified yesterday before the House Financial Services Committee. And in his remarks delivered, Powell made this statement: output and employment remain far below their pre-pandemic levels, and the path forward for the economy is extraordinarily uncertain and will depend in large part on our success in containing the virus. A full recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. And I thought that his assessment was good there, and it's a good assessment of where we are at this juncture, in my view. And I wanted to take you through some of the data that came out over the last few weeks and really take a deeper dive into the view that people will need to be confident from a public health perspective before a full economic recovery is likely. So one of the things to remember is that consumer spending accounts for 2/3 of economic growth in the US. So the financial health of the consumer and consumer confidence is critical to a sustained recovery. And what this chart shows is the decline in personal consumption of the Great Recession, which is in blue, that's the recession that occurred in 2008, to the current recession that we're in, with data through the middle of June, which is shown in green. That's the COVID-19 recession. Now, typically recessions are driven by a drop in spending on durable goods. So durable goods are those items that tend to be a little more expensive and last for many years, like refrigerators, automobiles, computers, televisions. And this chart illustrates what that normally looks like. So during the Great Recession, if you look at the first blue bar in this chart, during the Great Recession, there was a 58.6% drop in spending on durables. But this recession is different in that it's driven primarily by a decline in spending at restaurants, hotels, and service establishments that require in-person contact, as shown in the right-hand side of the chart. Through June 17th, 67.2% of the decline in personal consumption has been in the services sector. So very different than what we experienced in past recessions. And you might be thinking, well, of course, Hillary, I knew that. Obviously, during a pandemic, demand for in-person services would be lower. But what I wanted to show you here is that the interesting thing about this study is who stopped spending money. This is a recent study led by a team of highly regarded economists. And what they did was they divided household incomes into quintiles and compared the changes in consumer spending during 2020 to the spending year of 2019. And what you can see here is that those in the top quartile for income, the green on this chart, account for a whopping 53% of the aggregate decline in spending this year, while those in the bottom income quintile, blue on this chart, account for only 5% of decline in spending. And digging further, what they found is that the decline in consumer spending is mostly in rich zip codes. So this chart divides the US into counties instead of zip codes because it's a little bit easier to read when you're not getting so granular on the zip code level. But I think it still helps illustrate the point. So if you take a quick look, you might be able to pick out the county in which you live here. We have quite a few listeners in Center County, Pennsylvania. You can see that's dark red. The Orlando area where we also have quite a few clients, that's orange to dark red. Roanoke Valley area, a little bit more difficult to pull out of this chart, given how many counties there are in Virginia. But what I really wanted to show you in this chart is that the study found that in rich zip codes, which are, the orange to darker red on this chart, small businesses saw a drop in revenue of greater than 50%, about a 50 to 70% drop in revenue for the darkest red on this chart, while companies in poorer zip codes had a 10 to 30% drop in revenue, which are the yellow to blue areas on this chart. And furthermore, the huge decline in revenue at businesses in the richer zip codes led those businesses to lay off nearly 70% of their employees. And those employees are mostly low-wage workers, while businesses in poorer zip codes laid off only about 30% of their employees, which is still a staggering rate, but much less than what we saw in the richer zip codes. And overall, really what the study found is that the initial impacts of COVID-19 on economic activity appear to be largely driven by a reduction in spending by higher income individuals due to health concerns, which in turn affected businesses that cater to the rich, such as small businesses in very affluent areas. And this ultimately reduced incomes and increased unemployment for low-wage workers. So low-wage workers have been the hardest hit by the pandemic. And while the government acted quickly to get stimulus payments out to help bridge the loss of wages due to the shutdown, the data that's come in so far has shown us that most of this money was spent in sectors that require limited physical interaction. I'm not going to show the chart on this, but the data shows that spending on durable goods surged to levels that were well above pre-crisis levels after the stimulus payments were sent, while spending on consumption of in-person services, such as restaurants, increased very little and remains more than 50% below pre-crisis levels. So as a result, while we had the CARES Act and stimulus that went out to many, many households across our country, the current data shows that there was very little increased spending that flowed to businesses that were most affected by the COVID-19 shock, such as small businesses in affluent areas. And this potentially limits the capacity of the stimulus to increase economic activity and employment in communities where the job losses were the largest. So you might be thinking, well, what impact did stay-at-home orders have? What impact did that have on consumer spending? Well, this was also a really interesting result of the study. This chart shows states that closed early, which is defined as March 19th to the 24th in light blue, and those that closed later, defined as March 30th through April 6th in dark blue. And then those that never closed are shown in green on this chart. And the interesting thing to note is that consumer spending fell sharply in most states before formal closures. You can see that by looking at the drop in consumer spending that's registered by the time you reach the first dotted line on this chart. So consumer spending was down about 20% before states enacted closing, which suggests that health concerns among consumers were the primary driver of the sharp decline in economic activity in March and April, because the consumer spending fell sharply in most states before formal closures began. And in terms of reopening economies also had modest impacts on economic activity. Spending and employment remained well below baseline levels even after reopenings, and in particular did not rise more rapidly in states that reopened earlier, which is the green line there, relative to comparable states that reopened later. which is shown by the blue line. So overall, taking all this information together in terms of where the decline in spending is coming from, which areas of the country that's in, how business closures and reopenings affected spending, overall, what the data suggests that we have so far, and of course the data could change, we only have data through mid-June at this point, but overall the data suggests that the primary barrier to economic activity is depressed consumer spending due to the health threat of COVID-19 itself. And the public is not psychologically immune to COVID-19 and may retrench if the virus starts spreading again, regardless of government restrictions or lack thereof. And that's particularly the case for older Americans who are in greater danger of dying from the virus if they contract it. So baby boomers account for approximately 30 to 35% of consumer spending in the US, and they are also the most at risk if they were to contract the virus. And additionally, many high-income individuals are able to work remotely, are choosing to self-isolate, and are being cautious given health concerns. And so as a result, low-income workers, especially those in affluent communities, have been disproportionately affected by the COVID-19 crisis, as small businesses in those areas have been hit the hardest. And so in the long run, it does seem to me that I agree with Jerome Powell here, that the path to full economic recovery in the long run may be to restore consumer confidence by addressing the virus itself, because traditional tools that are used in recession to revive the economy, such as stimulus payments and actions and interest rates by the Federal Reserve, those may have only short-run impacts in an environment where consumer spending seems to be fundamentally constrained by health concerns. So given this backdrop of what we're seeing in consumer spending, and again, given that consumer spending accounts for 2/3 of economic growth in the US, this is a very important consideration looking ahead at what might be coming to the markets. But given this backdrop of what we're seeing in consumer spending, it's not surprising that the market has taken a pause in June, given the uptick in hospitalizations and the percentage of positive test results in many states. Throughout the quarter, we engaged in several rounds of opportunistic rebalancing to take advantage of shorter-term market dislocations, and those rebalancings have been very beneficial to our clients. We also took the opportunity to reposition our portfolios into some higher conviction ideas that we think will weather the storm that may or may not be coming over the next 6 months. Again, this is a very unknown risk to the markets, but we're positioning portfolios for what we believe is the most likely outcome. And we also continue to invest in many funds that are making a positive impact. So I stated earlier that low-income workers have been disproportionately affected by the pandemic, and I wanted to remind all of our clients that we invest some of your assets in fund companies that engage in positive impact within our communities. So for example, one of the funds we invest in has a portion dedicated to community investment notes, which give you the ability to support organizations that strengthen communities. So these notes are invested in areas such as affordable housing, microfinance, supporting small businesses, and offering educational opportunities for the underprivileged. And so while you are out there serving others on the ground, we continue to look for ways to serve others through your investments as well, while also offering a good risk return profile for our clients in the meantime. So overall, we continue to assess the market environment closely, especially as it relates to the pandemic, and we will make changes to the portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions that you may have.